Clayton's the only one here today. I haven't heard, I don't think, from Huey or Jonathan or Cole. Terry, I know you're always live streaming. I want to stress to all of you, we need you tomorrow night. I'll be here at least a quarter to 4 to get those machines booted up. Because these people come early, we need to go. I just hope we have a lot of help tomorrow night. Um, Taxes, we'll have our night class will be over before we know it. For example, what's the day, Clayton?
19th March.
All right, 19th of March. Tomorrow will be the 20th. And then we'll have the 27th of March. And March has 31 days, so we'll have the 3rd of April and the 10th of April. So you got 4 more nights to get your number of returns prepared. And after tomorrow night, 3 more nights. So our class is over on April the 10th. One good thing about it, it starts later and ends sooner. No test, no book. So really, it's a good deal.
How many returns we have?
How many have you got, Clayton, so far?
31.
You already got 31? All right. You need a minimum of 50, 45 for an A, and 5 required for class. 19. 4 more nights, all you got to do is about 5 a night. But now, any you do over, Clayton does 7 over, and he's got a 83 on his final grade. We're only going to be able to get in 3 tests. We've had 1. If I had that 7 points to it, he would have an A, brought up from a B. Now, if Clayton only had a 73 and he did 17 over, he'd still have an A. So one thing helps another one, of course, in this class. Now, we had a test. We only had 1 grade. Nobody got a D or an F turned in for midterm. And that's the way I like it in taxes. Of course, nobody got an F turned in for VITA for midterm. All right, now we have covered individual taxes, chapter 14, back to 11. If I could flip through, 11 was still individuals on income, inventories, what have you. All right, 12. Was on individuals receiving boot and 3-party exchanges, like kind exchanges. Could have spent a lot more time in voluntary conversions and selling of a home. Could have spent more time on that chapter. Well, I'll be truthful with you. We could always spend more time on every chapter because they've all loaded with stuff. All right. We didn't get to cover. Clayton, your test was on what? Your test was on.
That's what we just took last.
Was it just 11 and 12, or was it? Huh?
11, 12.
14.
Yeah. We skipped.
All right. Now, what I'm going to try to do is show you some PowerPoint for a minute on chapter 13. Now, chapter 13 will be our last chapter on individual taxes. All right. Nothing has changed, so I'll probably have to show you, since the PowerPoint from the company did not work good. These 18 PowerPoints have not changed. So let me show you a few things on chapter 13. Wow, wrong business here. That's corporations, estates, and trust. I better get down to individuals. Now, after this chapter, we're not going to spend a long time on it. We're going to run into corporations. So please read this chapter, be working on even problems. Now, this chapter, we're going to be talking about capital gain and ordinary gain. And it's revisiting capital gains, but these are business properties, and you'll see why. All right, we're going to be looking at 1231 gains. That's except gains over losses. It's treated as long-term capital gain. Now, let me give you an example. We have a piece of property with its adjusted basis of 9,000. That's AJ, AB adjusted basis. We may have paid 20 for it. Well, I guess I better give you that too. We paid 20 for it. We had 11 depreciation. All right. Now you know that its adjusted basis is 9. Now, if we sell that for anything less than 20,000, 19, how much of a gain do we have, Clayton? Right. That's going to be an ordinary gain. All right. If we sell it for 10, how much of a gain do we have? 1,000. That's going to be an ordinary gain, not a long-term capital gain, because it's called recapture of depreciation. All right. 11,000 is depreciation. Now, if we sell it for 22, Clayton, since you're the only one I've got to pick on, how much of a gain do we have? All right, 13. Now, the depreciation of 11 is recaptured. That's 11,000. That is ordinary gain called section 1245. Now, the 2,000 will be section 1231, long-term gain. That's what you got to get a handle on this chapter. Types of section 1231 property. We can depreciate livestock, unharvested crops and timber and coal and oil. Real property, trade or business. Real property, we know that's land. We know here you have depletion. Here you have depreciation. It includes inventory, inventory is not a capital item in any way. Letters, artistic, literary. Here we can sell timber and have a capital gain treatment. But hold it here for it to be long term. Now we have to take the fair market value of timber. I am going to get right down to netted section 1231 capital gain. We've netted into past. We know that cash losses, the net of that. Seller exchange of property. Here's the deal in this chapter. Two big words. Learn that, and that'll help you learn this chapter. Depreciation, recapture. All right, recapture will convert that part of the gain from capital in nature to ordinary income. Clayton, that example I gave you, we had $20,000, $9,000 depreciation, or 11. Adjusted basis was 9. If we sold it for anything less than 20, it's recaptured. If I sell it for 18, I do have a realized gain of 9 and a recognized gain of 9. It will be section 1245. Section 1245. Now, if I sold it for 20, like I asked Two, as I asked Clayton, we've got a 13,000 gain. 9 of that would be recapture, 4 of it would be long term. Section 1245 property is the business property. That's automobiles, livestock, computers, intangible property that we amortize, and real property, businesses that we depreciate. You can depreciate it, amortize it, it may be section 1241.5 property. All right, Clayton. You're the only one I got to pick on. So I'm going to give you a quick example here. I had a piece of equipment on the books for 25. I depreciated that 15,000. Cost, depreciation. Now my basis and book value are pretty much the same thing. Now, Clayton, I'm going to sell that for 24,000. Then I'm going to sell it for 30,000. How do I treat the gain for 24, and how do I treat the gain on 30,000 sale price?
Where's the 1245?
All right, 24. If I subtract 10, I have a gain of how much? Wait, 10 from 24 is 14, right? And you're right, Clayton. You're right. That 14,000 will be section 1245. That's called recapture or depreciation. That's what the chapter is about so far. Now, how about this next example, Clayton? Can you do as well on it? Yeah. We have a 20,000 gain, right?
Right. So it would be 1231.
But how much of it's 1231?
5.
Yes. All right, 15 is recapture, which is 1245. And the other 5 is above and beyond the original cost, and that makes that 1231. Now that's hard for a lot of students to see, and Clayton's pretty much picked it up, so I assume everybody else should, okay? Now the section 1250 is similar to 1245, but it's for real estate, buildings. That includes residential rental property because that's buildings. But it works a little bit different. On recapture is taxed at a maximum rate of 25%. Now, if it's low income housing, you get, excuse me, most all the gain will be capital gain, 1231. Corporations, we'll deal with that when we get to chapter 2 in corporations. Excuse me, gosh. Other recapture provision on donations and voluntary conversions, talking sales, like kind. We usually don't deal too much with that. Excuse me a minute, I'm gonna have to sneeze a couple of times. I'll be right back. I ate something sweet for lunch, Clayton, and anything sweet makes me sneeze. Just about anything. All right, now here's a form I want you to be familiar with. See if I can blow it up a little bit. All right, that's 200%. Okay, now Clayton, on this form, you can run them off rs.gov. We'll go to part 1, sales or exchange of property used in trade or business and involuntary conversion from casualty or theft. Most property, of course, help more than a year for it to be a capital gain. And what you do here, put your ordinary gains and losses here. I usually skip this first part, property used in trade or business and involuntary conversion. But I like to go straight to the back. If I can go, yeah, here it is. All right, now here we're selling equipment. Now, Clayton, look at this. We acquired it in 14, we're selling in 16, so it's going to be long term, more than a year. Okay, now we're going to sell that property for 60,000. All right, but this form will work out that 31 and 45 stuff for you. And doing taxes over the years for truckers that sell their coal truck, I'd have to do this form. Didn't used to like it, but it's not hard. All right, this property cost 58,000. Okay, but now we had depreciated it 27,000. So its book value, adjusted basis, is 30,000 or 35. Now, anything we sell that property for up to 60,000 is Section 1245 recapture. So total gain is 29,565. Now, Clayton, subtract the depreciation of 27,565 from 29,565. What?
2,000.
Clearly, it's 2, isn't it?
Yeah.
I wanted to see that. All right. It's Section 1245 depreciation. There's your Section 1245, right? Your depreciation. Now, follow it on down. All right. Now, look at your bottom lines. gain 29,565. Add properties, enter here, and on line 13. Remember line 13. I'll go back to it. Now subtract line 31 from 30. Now enter the portion from other than casual theft on line 6. All right, so remember that 2. 2 goes on what line, Clayton? 2765 goes on what line? We know this is going to be section 1245. We know this is going to be section 1231. Now let's go back and look at the front of the form. Clayton, I can't see the lines there. Well, I can over here, can't I? It said put that 2000 on line 6, right? Now, that's going to be section 1231, and that's going to be long term. What does it say to do on line 7? All right, we'll see where we put that. Now, let's go down and check line 13. Now, what does it say up here that line 13 is? Section 1245, ordinary gain. Recapture depreciation, up to 27 something. Section 1231, long-term capital gain. All right, let's look at the bottom of the page. B part, predetermined the gain or loss on line 17. It says enter here and on form 1040, line 14. 1040, line 14 is going to be 47, 30, 47, whatever the name of this form is, 4797. That's going to be ordinary income. So, you see the purpose of the form, Clayton? If you follow the form, you're in good shape. Now, I want to see what's at the bottom of this form. Now, here's where it said to take it to. Over here somewhere is where we took it. Won't give me a blank form. What does it say on 32 down here? Enter the portion of casual theft, blah, blah, line 35. Line 6, we did that. But if you follow that form through, follow this through, that 2000 would end up on a Schedule D, and it would be put as long-term capital gain on your 1040. It will end up on a Schedule D.
Would they put it there for you? You gotta go.
Well, now, if I were using TurboTax, it'll put it there for you. If I were using IRS's program, they'd put it there for you. If you're doing it manual, you got to know to put it in Schedule D and carry it over to 1040. It don't even tell you here. It used to tell you.
Yeah, I think see something about Schedule D, right? Individual partners.
What line do you see there?
Right below your cursor.
All right, individual, partner, and all others. If line 7 is 0, it's not, or a loss, enter the amount from line 7 on line 11 below and skip lines 8 and 9. Now, if line 7 is a gain, which it is, 2000, and you didn't have any prior year section 1231 losses, if you did, it would subtract it from it, or they were recaptured in earlier years, enter the gain from line 7 as a long-term capital gain on the Schedule D. You're right, Clayton. I knew it should have mentioned that. File with your return and skip lines 8, 9, and 11. All right? So we skip lines 8, 9, and 11. Okay? And I would stop this form right there. And I would do what the instruction said right there for number 7. Okay? So that is a lot of your chapter. Okay. I want you to read this chapter for Thursday and be working on the even problems. And I will lecture some on the chapter on Thursday. But today, we're going to go on to chapter 2 on corporations. Now, chapter 1 on corporations, why do I skip it? It's like I skipped chapter 1 on individuals. Chapter 1 on individuals is how the law is made and IRS code and keywords and how you search and how you do tax research. We don't do tax research. Now, chapter 1, why do you do tax research for corporations? You see if there's been another situation filed like yours. You go to see if it's been won or lost in court. So that's what that's about. Now we're going to corporation formation and capital structure. Now, I'll probably use a PowerPoint later on this, but not today. All right, look at page 2 if you're home or wherever. Organizational forms available. Sole proprietorship. We've done that on Schedule C. Partnerships. If we're lucky, we'll look at a chapter, but probably not. Corporations. If you can do a corporation, you can do a partnership. Now, there are sub-S corporations. Then there's the LLC. So I count these 4 first ones as our main organizational forms. Proprietorship, partnership, corporation. Now, even accounting principles is starting to mention the limited liability company. The entries are almost the same. Now, limited liability partnership, those are few and far between. A sole proprietorship. Clayton, let's say you did tax preparation this year and cleared $4,000. You do a Schedule C, sole proprietorship, and you put it on your Form 1040, don't you? And you pay Social Security tax. You do a C, you do an SE. The owner is taxed. Now, we've got tax advantages and disadvantages. The sole proprietor is not subject to double taxation. Profits may qualify for 20% that qualified industrial or something, other business deduction. Your tax rate may be lower than the marginal tax rate that would have applied had the business been incorporated. The owner may contribute in cash to or withdraw anytime he wants. You maintain separate books. The owner may contribute in property. Business losses can offset your W-2 wages. Now, you've seen advantages and disadvantages of these forms in business law, maybe accounting, different areas. The tax disadvantages, the profits of a sole proprietorship are taxed at your rate. If you were in a 39% tax rate, they're taxed at that. But if you're in a 15% tax rate, they're only taxed at 15. Sole proprietor must pay the full amount of the Social Security tax. He's got to pay double, 2 times 65. 765 times 2 is 15.3. All right. However, we know we get a break on that. So if you're working for the man, you pay 7.65. And the man pays 7.65. And Johnson Case, Food City pays 7.65. All right. Now, add that together, you got 15.3 if you're self-employed. But you get to multiply that by 90-some%, which brings it down. Sole proprietors may not deduct compensation paid to owner employees. Certain taxes and benefits available to shareholders only. Sole proprietor must use the same accounting period for the business as the person. Now, what are we saying here? If I can get another blank page here or something. All right, a sole proprietor is a one owner. He pays his own personal taxes. Now, Clayton, if you did your little accounting practice and you made $8,000 net profit, but you only took out 5, you left 3 in your business, maybe to buy computers with next year, whatever, tax programs. Now, your capital increase is 3,000. All right, we know net profit is a plus to capital. We know a withdrawal is a minus to capital. We know your capital increased by 3,000. All right. Now, what amount are you taxed on? That's what you left in the business.
Oh, okay. Thanks a lot.
Well, it's either the 8 or the 5. Is it your net profit or your withdrawal?
I'd say probably
Net profit. You're taxed on the net profit now, and your taxes and Social Security. It don't matter if you take it all out or none out. Now let's say you took out 9,000. You're decreasing capital by 1. You're taxed only on 8,000, and this 1,000 is a return of capital. All right. So a sole proprietorship is pretty much an easy return. Okay. Now let's look at corporations, advantages, disadvantages, or partnership. On page 4, the partnership pays no taxes. Now everything is passed through. A partnership does a 1065 return. They do a K and they do K1s. There's 2 partners, they do 2 K1s. These add up to be what's on the K. If the K has just simple 10,000 net income, partner split 50-50, your K1, Clayton will have 5,000 and your partner would have 5. You'd be taxed on 5. That goes, this K1 goes to a Schedule E, and the Schedule E goes to your 1040. I don't like partnerships. So if you can do a corporation, you can do a partnership. I got some of my clients to incorporate just so I wouldn't have to do a partnership tax return.
Just like two partnerships, just like two separate ones. We gotta do.
Yeah, like two different people. You split everything.
Double the work.
Yeah, you split the 179 and everything. Yeah. A partner's tax rate may be lower than a corporate. Partner's income is not subject to double taxation. Additional taxes might be imposed. All right. So the only advantages I can tell you about a partnership might not be mentioned here. You take in a partner to get more capital. All right, you take in a partner maybe to get more knowledge. He's got the knowledge you don't have. That's why a lot of attorneys went into the mining business with accountants and mining superintendents. One knew the mining business, one knew the financial business, and one knew the attorney business. And that made a good partnership in coal mining business. All right. A big advantage of a partnership is more capital and more people do the work. Now, if you're a proprietorship, you have to do, let's say you were a proprietorship and you had a little zip in market with gasoline, you got to be a jack of all trades. You may hire some help, but you got to be a stock boy, you got to be a clerk, you got to be a purchasing agent, you got to be a marketing agent, you got to be a jack of all trades. Now let's take that same little zip in market and hire a partner. He may be better at the accounting and the purchasing, and you may be better at stocking and cashier. So you split knowledge. Now, disadvantage of a partnership, all the partnership profits are taxed to the partners. A partner tax rate could be higher than a corporation. The partner is not considered to be an employee. Now, the partnership or proprietorship pays you $5,000 a month, Clayton. That's your wages. That's Schedule C or 1065. Partner. What entry do I make for that $5,000 each month? Whether you're Clayton, you're Schedule C and a proprietor, or whether you are partners, let's say, with Jonathan. What entry do I make when I give you $5,000?
$5,000 per month.
Yeah. All right. What entry do I make if I give you $5,000 a month? What do I debit? Clayton drawing. You are not an employee of a proprietorship or a partnership. You are responsible for your own taxes in both. You maybe should do quarterly taxes if you're getting $5,000 a month, right? Now, Clayton, if you were incorporated, you can make yourself an employee of a corporation, right? All right, then you would credit cash and you would debit but I'd deduct taxes. If you're working for a corporation, even though you own it, you can give yourself a W-2. I would withhold, the federal income tax, Social Security, Medicaid, Medicare. Now, the point I made, you can be an employee of a corporation, but you cannot of a proprietorship or partnership. It's withdrawals. Now, same old question again, Clayton. You're a partner with Jonathan, and y'all made 100,000 this year. You split profits equal. You get 50 of that, right? All right, but let's say you only took out 40. How much are you taxed on? All right, you got it. You're taxed on what you make, not on what you take. All right? Now that's a simple statement. You're taxed on what you make, not on what you take. Now, a tax disadvantage of a partnership, and they don't have one here that I like. Now, a partnership, we're looking at taxes here. We know it has limited life and unlimited liability, but a big problem with a partnership is disagreement. But that's not a tax disadvantage. Now, a corporation, we know we sell stock when we form a corporation. And look at the tax advantages. A C corporation is an entry separate and distinct from its owners. You can sue or you can be sued. Shareholders can be employees. All right? A corporation may deduct ordinary necessary business expense such as salaries to the owners. They can use a fiscal instead of a calendar year. They can use March the 31st instead of December. Now that's some advantages of corporation. Now, let me point out something else on a corporation. All right, Clayton, you own 50% of the stock in the corporation. I own the other 50. All right, the corporation made $60,000. All right, we know you're entitled to half of this. Now, if the corporation makes money, its market value should go up. Let's say you paid $10 a share, and we paid $10 a share for our stock. Now, you're an employee, Clayton, and you only took out $10,000 this year for salary. I took out 15 because I work more. Now, the corporation is going to pay, under Trump, 21% taxes. All right? What are you going to pay taxes on? 30,000 or 10? Yeah. You own 50%? No. Only in a partnership would that happen. In a corporation, you're taxed on what you take out because you're an employee. You're not taking out withdrawals. And I'm taxed on what I get. Now, let's say the corporation pays 21% in taxes. How much is that? Now, let's say they gave you a $10,000 dividend and me a $10,000 dividend. All right, let's say you're in a 15% tax bracket. You pay $1,500, right? Let's say I'm in a 25% tax bracket. I pay $2,500. All right, it depends on our tax brackets. So these are dividends. You are taxed at your rate, and I'm taxed at mine. Of course, we can get it classified. I may get a capital gain break there. So, how much taxes is on that money when it comes to you, Clayton? 21 plus 15 is how much? 36. And here, 21 plus 25 is 56. You see, Clayton, that's where you get the double taxation on a corporation. That makes sense. Get my chair seated here. All right. Back to a partnership. Disagreements is the biggest reason they split, just like a marriage. Disagreements on a marriage. And when it comes to marriage, finance is the number one reason to divorce. Right? Now, look at your other tax advantages of a tax disadvantage of a corporation. Double taxation. Number one, I just explained that. Shareholders generally cannot withdraw money or property. You can't just go take it out like you can a partnership or proprietorship. Net operating losses confer no tax benefit. If the corporation has a loss, you don't get any benefit from it. You can carry it over on the corporation. Capital losses confer no tax benefit to the owners in the year the corporation incurs them. Now we're going to look at an S corporation later, but that's the three main kinds. Now, let's see, in the front or the back of your book, right, go to the back of your book, Clayton, just a hard page. Do you have the last page in your book on that computer?
Is it the
Corporation tax rates.
yeah?
Define them. I'll show them to you here on Gizmo. If I can get Gizmo working.
Is it like this?
Huh?
2018 tax rate schedule?
Yeah.
Yeah, I got it.
Well, I'm going to let well enough alone. Is that what you see, Clayton? These are the old tax rates.
Yeah, that's what
These are not Trump's tax rates. Not Trump. Now, Clayton, jot down $125,000 income. Calculate the tax on 125,000. While I try to look at the real tax rates. I can't find it for 2018, Clayton. Let's see. Try it that way. See, here's what it gives me, Clayton. Corporate tax rates for 5 through 17. I don't want them. Okay, Clayton, read this right here. Read this paragraph right here.
The tax cuts and
Read this paragraph.
the Tax Cuts and Job Act of 2017 changed the top corporate tax rate from 35% to one flat rate of 21%. This rate will be effective for corporations whose tax year begins after January 1st, 2018, and is a permanent change. Corporation tax rate also applies to the limited liability corporation who have elected to be taxed as corporations. This rate does not apply to S corporations.
Now, why does it not apply to S corporation? Because you're taxed like a partnership. It's passed through like a partner, and partnership, and S corporations, you're taxed different. You're taxed at your tax bracket. But now here, what amount did I give you to calculate tax on just now? 125,000.
Yeah.
Multiply that by 21%.
$26,250.
All right, that would be the 2018 tax. But did you do the 2017 tax?
71. Because right there it says you add 22,000 to it. You add 22,000 to the other one.
No, Clay. Let me go back to Gizmo over here. All right, let's look at Gizmo. Now I want you to jot down 100,000.
Oh, I know.
The taxes is 22,250. Got that? Now subtract 100,000 from 125. Now multiply that 25,000 by 39%. Multiply 25,000.
9,750.
Now add that 9,750 to 22,250. Take 22,250, add to 9,000 something.
32,000.
All right. If Trump had to change the tax rate, you'd have paid 32,000 what? Even? All right, but the 21% came out to be how much?
26,250.
So they save money by his new tax law, right?
Right.
But here's where they don't save money. Right, if they used to pay 15% under 50, now they're going to pay 21% under 50. So that's the new and the old tax laws on calculating taxes. Okay. Now, if you have a book or anybody has a book, flip it back to page 2-8. 2-8 corporations. All right, corporation has a lot of regulations, legal requirement, tax situation related to forming a corporation. If you look at page 9, and we got these articles of incorporation and issuing stock and legal fees and accounting fees, we know we can count that as organizational cost and amortize it, or take it off as a current expense. All right, you might want to look at page 2-11. And look how property is transferred to a corporation. All right, now look at the next page, 12. Now this is a little section hard to understand. Section 351. If I transfer property to a corporation and I get stock, does the corporation take a gain on that property, or do I take a gain on that property? That's what you're going to be reading in these few pages. It's hard to understand. All right, that's transfers to corporations. So my only assignment is read this chapter. Now for Thursday, we're going back to chapter 13. We're going to look at problems on chapter 13. We're going to continue at chapter 2 on corporations. And Clayton, I want to let you out early today since there's only one here. We're going to get at least 15 minutes on us here. And I got to find your cost accounting test. So everybody, please try to make it out tomorrow night. Don't leave us in a bind. I hope nobody has the flu. And I hope nobody kidnapped Code.